State 360 Live. I'm your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Reminder that the show is designed to build the Washington, D.C. Metro's housing markets by giving you good free advice, whether it's, you're trying to obtain a loan modification and, just running into roadblock after roadblock, whether you're trying to refinance the lowest rates in U.S. history, or select the best real estate agent for you to represent you in a transaction. We can help you out with all those things. The best phone number to reach out to us is 877-245-2030. That's 877-245-2030. Or visit us via the web at realestate360live.com. That's realestate360live.com. So a few weeks back I had mentioned that, FHA had planned on, in 2013, potentially raising their mortgage insurance premiums again. Louis, you and I, we had spoke about this, it was probably, maybe 3 or 4 weeks ago. And basically, FHA is out there to be a program that's has a smaller down payment, basically one of the lowest down payments that you can get to be able to purchase a home. 3.5%. And for that, FHA has to be able to stay in business, and they have to be able to have, reserves that are met, that are set by Congress. And when the reserves start to fall short, they have to raise those premiums up to compensate for that. Well, if we go back from 2009, the FHA charged a 0.55% mortgage insurance premium monthly. In 2010, it was 0.9%. In 2011, it changed to 1.1%. Now in 2012, it changed to 1.25%. So in roughly 3 years, we've more than doubled what it was being charged. Now, the Federal Housing Administration's Fiscal Solvency Act of 2012 has sailed through the House of Representatives with a 98% vote. And it's mainly because there's so many of these loans that are being done. Basically, in 2000, I believe back in May, somewhere in May around of 2012, there was a statistic that said that basically 1 in 5 home loans were FHA insured. So they're trying to shore up once again the amount of reserves that they have, and the two proposed changes to how FHA mortgage insurance premiums are paid was, one, to establish a floor for the annual mortgage insurance premium of 0.55%. So no matter what, if you take out an FHA mortgage, or there's a 30-year or 15, there's a floor of a minimum of 0.55. But the second thing was to grant the FHA the ability to charge up to 2.05% in annual mortgage insurance premiums. Now, for those of you out there, this is a proposed change, giving FHA the ability to raise it up that high. Is there anybody out there that really thinks that they're not gonna do that? Because the way I see it is that they feel like that there's no competition out there. Okay, is it going to drive up the cost of a mortgage? Of course it is. It's going to almost add double the mortgage insurance payment, because right now it's 1.25. You go up to 2.05. It's really going to start offsetting these interest rates. So even though your interest rate could be 3.5%. By the time you're paying your mortgage insurance premium that could potentially go up to 2.05 monthly, your interest rate, if you just broke that down, it could be closer to maybe 5.5%, 6%. So even though it seems like, interest rates are great, they're almost, being negated by the fact that FHA continues to raise up these premiums.
And Ryan, that FHA has a $16.3 billion deficit.
Yep.
And they're going to need money, and they're going to try to raise it by increasing fees and asking for a bailout. And only monopolies can do something like that, because these are the loans that you have to get. 30-35% of mortgages are FHA loans, so they're in a position where people are relying on them because of a government monopoly to make these loans, and they'll just raise the fees to try to raise revenue. And where that doesn't work, they'll ask for a bailout.
Yeah, so who ultimately pays the price in this situation is the consumer. Because,
and the taxpayer.
And the taxpayer. It's interesting because these programs...
the government's supposed to be giving us something,
right,
benefit, and we have to pay more for it for the privilege of getting it for more money.
Right, and it's like, okay, well, I really don't want this benefit anymore, but the problem is that there's no competition out there. There's nobody else out there. Yeah, that is really coming out with a program that I mean, there's I take that back, because there are some small credit unions, okay, that do offer some low down payment, 3%, 5% downs with no mortgage insurance premiums, okay. So those are out there, and
it's hard to make money on that.
Yeah, it's hard to make money on those, and
low interest rates.
They're low interest rates, but you also have a lot of income restrictions and things like that. So they sound like great programs, but when you've got the masses flooding to try to take advantage of those, they soon realize that, hey, I'm over the income restriction of like $75,000, so I no longer qualify for this. Or my qualifying ratios, they're supposed to be under 40%, and mine's 40.5, so I no longer qualify. So, versus FHA has much more lenient guidelines where, you've seen loans go through that could have debt to income ratios of 55%. So you're going to pay the price for that as well. I mean, and that's why these premiums continue to go up. And, I would advise people that if you're considering purchasing and that FHA is going to be the way that you go ahead and start looking now, today, because 2013 is right around the corner, and they're going to be looking to boost up these premiums. I can almost guarantee that that's happening. Whether it goes to the 2.05%, I don't know, but since went ahead and it was written into that bill that way, they're probably going to go ahead and do it.
Now, keep in mind, Ryan, that the FHA not only writes the 30% of the new mortgages, but they guarantee all of the mortgages, basically.
Yeah,
and that's probably where their losses really are coming up, because there's a lot of defaults.
Well, there's a ton of defaults, and it's not just defaults on on the new loans. I mean, I would assume. Logic seems to be that, at the low interest rates, you're probably going to have less people defaulting, because they're going to hopefully see that they don't ever want to, lose that low interest rate that they're taking advantage of. But, life still does happen, and people still do lose their jobs, and people can't pay their mortgages. So they're going to continue to have defaults across the board. And, I think it's kind of crazy, but, I just remember when FHA used to be a great program. I mean, it was a great program for first-time home buyers. This was their first house where, there was a mortgage insurance premium, but it was reasonable for the amount of down payment that the person was putting down. But now, I have to say, I would be looking to try to find an alternative route at this point, especially if this mortgage insurance premium hike takes place in 2013. It's just not going to be as beneficial.
Homes, it goes up even higher.
Absolutely. You're talking, could be like on a $500,000 or $600,000 home, you could have monthly mortgage insurance premiums $500-$600 a month. How much more of a mortgage payment could you, or a sales price could you afford if you didn't have the mortgage insurance premium? And I've actually had a few of my contacts and sources actually tell me that FHA is actually considering making it so that mortgage insurance premium, it not only you have that hike, but it's going to be for the life of the loan. Where before, if you had it, you had to keep it for a minimum of 5 years, and after the 5 years, if you're at a 78% loan to value or less, then you can get that mortgage insurance premium removed. Well, now, yeah, that makes sense, right? So, but now they're trying to make it so that
they just want to collect the fee.
Yeah, they're just going to collect the fee for the life of the loan. So
even if you really don't need that insurance.
So what would that force people to do? So let's just say an example that somebody took out a loan in 2013 when the premium goes up to 2.05%. They know they're stuck with it. The only way out, so that they don't, if the premium stayed for the life of the loan, the only way out is to refinance at higher interest rates down the road. So, how is that a benefit to the consumer? It's not. It's really hurting them. So I would really think that what that's going to force people to do is to probably, try to get their credit scores raised up before they buy, to try to save up more of a down payment, which is not necessarily a bad thing. But it also, we don't know where interest rates are going to be a year or two from now. And
once you're in that mindset, you don't need FHA.
Absolutely. Because you can go conventional. Problem is that the conventional standards, Fannie Mae and Freddie Mac, what the standards that they're setting forth, they're so stringent right now that if you're not putting 20% down and you don't have a 700 FICO, it's difficult to get that loan. So, at the end of the day, it could be very
affordable housing created by the government.
I know it, and it's like, okay, that's great. We have the Fed manipulating interest rates. We have all these programs out there, but yet who can take advantage of them?
And how much are they costing to not be able to take advantage of them? In other words, we're spending all this money. All those government-sponsored entities are well into the red and require massive amounts of additional money, and they're not working.
Well, and to me, I would assume that you're better off to say, okay, I really want this to be a true first-time home buyer program. Here's the program's limitations. Don't make it for everybody, right? At least make it so somebody has to work towards it. I'm not saying give everybody a home loan because that's not what I believe in. I believe that, first off, I believe that you should have to probably go through some sort of class that explains to the consumer what affordability is. You know what I mean? And affordability is not just because the lender says that they're approved for a loan. Right? I think that there needs to be some sort of education out there that explains that, your mortgage is obviously going to be your largest expense, but, what is going to be manageable? What comes along with obtaining a mortgage? First-time home buyers, for the most part, are very unsure of what's going to happen once they move into that house. What are going to be all of the expenses that, especially, I'll just give you an example. A college kid that's been living at home with his parents saving up money to buy a home. Well, if they were living at home, they might not have been paying for groceries and utility bills and other things. But then all of a sudden they move into their first new home and, life kind of hits them in the face. Well, now I got grocery bills every 2 weeks of $200. I got my utility bills. I got everything else that comes along with the maintenance on the home. And, oh, by the way, that's still not car insurance. That's still not other things that are not, mind you, are not reported on a credit report. So, I think it is very important for people to reach out and understand the affordability factor of obtaining a mortgage. I'd be glad, if people want to sit down, I can put you in contact with a great, team of loan officers that can help you determine your affordability. 877-245-2030. We're coming up on a break, guys. When we come back, we're going to go over the National Association of Realtors Home Buyers and Sellers of 2012. When we come back, stay right there.
Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com.
You're listening to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Join Ryan every Monday on 1580 Gov.Biz Radio.